Hi, everyone. Welcome back to another episode of Trade with Conviction. I'm Felipe Elink Schuurman, and today I'm joined by Neil and first appearance, Jay Maroo. Hey, Jay, how are you?
I'm well, thanks. Great to be here, Felipe.
Nervous?
Not yet. We'll see how it goes given the markets.
We'll throw you some curveballs from time to time. And Neil, all good on your side?
All good, thanks. This is episode number 96, by the way. So we were just discussing
Exciting. We're approaching episode 100. We made it so far.
Yeah, so episode 100, Jay's suggestion was to have you and Miles doing your own podcast.
God, I mean, getting Miles on the pod, that would be, that's. I think you're asking for the impossible. But let's get the listeners to push for Miles to participate, and then maybe we can convince him. Anyway, so a lot of things to discuss. The whole merry-go-round around peace, no peace, deal, no deal, and obviously the impact on the different markets. Today we're going to be focusing on crude, distillates, and gasoline. But Neil, as usual, can you start off by giving us a bit of a summary of the news, the headlines, and what's going on?
Yeah, I can try. So obviously what's still incredible is that the flat price of Brent is still under $100 per barrel. If you told me that at the start of this conflict that we would be stuck there, I would have been very skeptical. And it's the same with spreads. If you look how low inventories are in various places like the US, you got spreads that are basically average levels. It's incredible. And the problem is the news cycle, right? It keeps people guessing. It keeps people from putting risk on, basically. And the new element to that was this whole Lebanon story this week. So Iran basically successfully kind of linked the Lebanon war, if you like, to the deal between the US and Iran itself, right? So that became a new challenge for Trump. And the question was going to be, can Washington kind of simultaneously, let's say, navigate the Lebanon story with Israel, as well as keep Iran, okay, I guess, happy, in that way. And last night we got the story that, there is going to be a ceasefire between Lebanon and Israel, but Hezbollah needs to stop its attacks. Hezbollah has not agreed to that yet. And there's going to be another round of talks in late June. So, what do we make of this? Like, it's just another reason not to place a long bet, right? And I think that's going to continue for weeks and weeks until it is not possible anymore. And, we've talked about US stocks, for example, being so low. At some point, there will be a kind of reckoning. And I've been talking this week about sleepwalking into low inventory situations. There was another...
Yeah, I was going to say, there's been 2 or 3, you had the CEO of Chevron going on the news talking about sleepwalking. I think the MD of Vitol at MPGC is sort of saying the same thing. It almost feels like, we've been crying wolf, us and everyone else, since the beginning of it. And, at least in the Western world, nothing really has happened, and we keep saying, the equity market doesn't make any sense, but equity market keeps rallying. No problems with jet fuel, no problems with gasoline, no one queuing at the pump, so okay, there's no problem, but there is an underlying problem.
Yeah, and it was interesting also because there is some nuance coming into it. If you look at US product stocks, they're sort of not as tight as they were. You're getting more runs. They're not drawing as hard as they were, but crude is becoming a bigger problem in my mind. So each week it's kind of like, okay, in the US specifically, what's the biggest problem? And I think that's shifted a little bit towards commercial crude because the draws on commercial crude inventory are accelerating and things are looking quite low. Cushing is drawing. We'll talk about this all later, but Cushing is near very problematic levels. So this idea of sleepwalking is, as soon as I still think it's going to go like this. We'll get this merry-go-round forever because that's what Trump kind of wants. I think that's what Iran kind of wants. And at some point, the market will say, okay, the US is empty and it's going to be US crude. And then the market will react and say, okay, we're not going to get max US crude exports. What happens now? It's just a question of when. I still think it's a couple of weeks away.
Yeah, the timing is the most important element here, and it's very difficult to judge. To a certain extent, the fundamental story hasn't really changed that much, but it's more, we sort of called it a bit too early, I would say, in terms of at the end of the day, as a trader, you are pricing in what will happen next, not what happened already. And we're seeing that. But of course, if it reopens, everything changes and that picture changes again. And again, we'll talk about it later, but I was looking at, in the gasoline, I was looking at historical seasonality, forward curves on a seasonal basis, and whether it's east-west, cracks, spreads, pretty much everything is right now at your mean over the last 5-6 years. Would you buy that or you sell that? And right now seems like a buy to me, because we've repriced to a point where putting yourself in a sort of like buying mode makes a little bit of sense. But even if the Strait reopens right now.
Yeah, and you started to see that in some elements of positioning, so caught CFTC data for the first time. There was quite a big gap in the sort of positioning between Brent and TI. So TI was neutral for a long time, and Brent was pretty crowded long. And the last week or two, alongside the flat price decline, you've seen that Brent positioning has turned more neutral relative to where it's been over the last 8 weeks. So obviously, it seems like, okay, if I have to have an entry point, maybe around now is a good time, absent all the sort of risk about headlines, right?
Yep. And there's also been some more and more discussion around Hormuz transit trickling higher. What can you tell us about that?
Yeah, interesting, Felipe. So you talk about positioning, but let's talk about positioning in the more physical sense with ships, right? So there has been a trickle more activity coming through the Hormuz, but still it's at very, very low levels. So something like 50 non-Iranian oil tankers have transited in May, but still that's 10% of pre-conflict level. So yes, a blip higher, but in the grand scheme of things, it doesn't change the underlying picture. And also, like, another interesting nugget I saw this week was apparently VLCC was beginning to load at Karg Island in Iran for the first time in 4 weeks. So clearly there is an appetite is still there to get oil out, but by no means is it free flowing, and by no means is it a quick recovery. We also hear that hundreds of vessels have reportedly applied to IOGC for safe passage. Yeah, given the uncertainty around what's happening with peace discussions, the ceasefire deal, until that happens, that doesn't really mean much in the concrete ground. One of the more interesting things I saw was a story about some Greek owners putting their ships outside of the Hormuz to be ready to pick up cargo if and when the straits open up. I think this is interesting because it shows that this kind of thing is being thought about for the first time. I think previously, if we look back 3 or 4 weeks ago, if you would have asked any major ship owner, they would have said, yeah, it's kind of stay away zone. But the Greeks have apparently, or some Greek owners have apparently tried to do this. And this makes sense. I mean, if we draw the parallel back to what happened with Russia and the price cap, typically it was the Greek owners that were most receptive and quick to jump on when the price flipped to be able to do the trade. So it makes sense that some owners are putting ships outside the Hormuz to pick up a cargo when it happens. I see this not as a kind of main strategy, but almost like a nice, relatively good call option for an owner to have. If many of the ships are already earning very, very nicely in other parts of the world, if US Atlantic Basin trade on VLCCs is very, very profitable, then for them to put a chip on the table and say, hey, we're going to leave a ship outside, we may not make a return on it, or we may do really big, but we have chips to play because things are going well, then it's perfectly logical. So I don't see any kind of massive accumulation of tankers, but yes, to see some is understandable, and to see some there's probably a slightly positive sign.
Indeed, I mean, the market is questioning. I remember when the Houthis were sort of blocking a bit Suez or that channel, and when you had like one vessel going through, then you had one company saying that they will go through, then everyone was sort of expecting that the floodgates would open, independently from any kind of ceasefire or settlement. But in the case of Hormuz, no, but it's, can you be in a situation where Hormuz is sort of semi-reopened and maybe you get back from 10% to 50%, and that is difficult to judge, very difficult.
Yeah, so I think the issue that isn't being talked about so much is people think of Hormuz as almost like a binary thing. Is it open or is it closed for all commercial purposes? Let's say in a world where a peace agreement is made, Iran and the US make up, and all of a sudden transit is available and free to all entities. Even in that scenario, it's not like there's going to be a flood of traffic going both ways, right? There are many, many ships stuck inside the Gulf, and the Strait of Hormuz is a narrow waterway for shipping purposes. Yes, physically it's wide, but for commercial traffic, I think it's 2 miles or something like that. So there's going to be a flood of flow one way. And like the analogy I like to give here, it's not like a field, it's like a runway. So if you think about an airport, if there are a bunch of planes waiting to take off, you can't have planes coming in ready to land and coming in at the same time. So even then, there's going to be a massive delay in getting the oil out and having these laden ships that are waiting outside pick up their cargo. So any kind of peace deal, any impact on shipping, it's going to be a real slow and long impact. It's not going to be a quick hey, the markets are great now because ships can move freely through it. It's not going to be free movement, even in the case where there's no threat of attack.
Interesting. I was not aware of that. Yeah. But Hormuz or the AG is not the only topic of discussion. In India, Neil, we saw product exports at 4-year lows. Can you tell us more about that?
Yeah, I've got a couple of things to get back to, more of our usual kind of schedule of talking occasionally about national statistics and things, which was what we did prior to this whole conflict. There's a couple that are related to really mostly to distillates, but products in general. One is Indian exports. So Indian product exports, as you said, in May are reportedly down to a 4-year low and down by several hundred kbd year on year. It goes in with the story that there's a great worry about domestic retail prices in India. So there's a desire, to get more product into the domestic market rather than the export market. And there's pressure from the top, basically. There has also been a desire to shift yields because LPG is the most, let's say, short product in India at the moment, being big importers. So reportedly, there's a big shift towards more light ends production over distillates. And the other thing that there was reliance maintenance. So it makes things difficult for the rest of the world. India was already not exporting diesel to Europe basically this whole time since the conflict started. And now the Indian diesel exports to the east, which had been sort of helping rescue the East, are probably going to decline if this kind of trend holds. The other two are Russia and China. So Russia is basically another they're both May stories. The problem is Russian crude runs are at multi-year lows. Some of that's due to maintenance, but a big chunk is due to the Ukrainian strikes. And the story that has been, we're all sort of aware of it in the background, but the story is that Ukraine's domestic drone and missile industry has been ramping up and is now far exceeding the Russian equivalent. And so they're just much more capable of ramping up their attacks on Russian refineries, and that's what they're doing. And so it's likely that Russian diesel exports are going to be quite low for a long time. That goes to Turkey and Brazil mostly. And actually there was a story this week that Russia's banning jet exports. Now, they didn't export that much jet, but they're also thinking about importing jet at the same time. So it's a very interesting story. The sort of Russian system is creaking slowly lower because of Ukraine. What it also means is they're exporting more crude and dirty products. So it looks like the May Russian crude export figure is going to be pretty big. And typically that's going to go to a place like India and China. And so it's another sort of reason to be kind of bearish their imports of legitimate spot crude, let's say. So it's quite an interesting little dynamic there. The last one, just before I stop my monologue, is Chinese exports. So you remember Chinese May exports of products were going to be, they were expected very high, and it kind of moved the market at the end of, or the beginning of last month, this whole story. Well, it didn't materialize. So looking at some of the figures, the total exports barely rose over April. May still ended about 500,000 barrels per day short of pre-war levels. And jet and MOGAS in particular are still extremely low. So it's relevant largely for the regrading for East-West MOGAS, which I think you'll go on to talk about, I think, Felipe. And diesel's been flat. So this whole expectation that China's going to rescue the market is not materializing. And there's a story that it looks like the government is going to allow the independent refineries to run a bit lower because they're struggling with their margins to a certain degree. So I don't know, the expectations for China in June are also probably getting a bit more bearish regarding their product exports.
And in regards to, just before we move on to distillates, in regards to imports, I saw that they were importing less, or what is the story there?
For crude, we did a bigger piece on this last week. So it is, I think, largely confirmed that their May imports are going to be something like 6 to 7 million barrels per day. Their normal level is 11. So they have massively changed the spot crude market. And I'll talk about that in a bit. But I think that's impacting WAF as well, and Brent probably as well. So it's one of the big solvers just now.
Yeah, very clear. Okay, so let's move on to our dedicated product sections. Jay, can you tell us more about distillates in general? What are you seeing? What are your expectations going forward?
Sure thing. So distillates been a fun one for me personally. So we had seen a kind of wider sell-off on distillates a while ago. This comes back to what we were seeing in crude and cross markets, this kind of narrative of a peace deal coming through, ice gas oil spreads, cracks. It was all looking weaker. And last week, actually, in our European chart pack, I made the comment that I thought this was a little bit overdone, and I thought the US was actually a good example of this. And with that in mind, I thought, okay, heating oil spreads are a good trade idea to have given where everything was. And of course, as you know, as a trader, whenever you make a call, everything you make on that call goes wrong and everything around you stands corrected. So what happened since then is basically all of this fresh concern, the geopolitical risk, the fresh strikes on Russia, the threat of Bab el-Mandeb also being closed as well. That really supported gas oil spreads, gas oil cracks, European cash diffs, heating oil cracks, in cracks. But the one thing it didn't support was heating oil spreads, which doesn't make sense to me. So maybe, maybe the trade is still there. And I think it's maybe even better value, but it hasn't moved up in sync in the same way the rest of the distillate complex has. If we talk about this risk on sentiment that's come back in distillates, it's similar to the one that's come in crude, but there are some slightly different physical nuances here. So Neil talked a little bit earlier about the Russian attack. So this hits Russian refineries, which is obviously impacting flows of Russian diesel to Brazil. But the nuance here is that in the absence of that flow, the Brazilian buyers have lent more heavily on US supplies, and US exports have been very, very high of late. And that also makes things difficult for supply to Europe. And that's something that's probably going to continue. And also to bear in mind on the Russian side of things is there's an element here of seasonality as well. So Russian diesel exports typically dip a little bit lower across the summer as well. So that means that pull from the US for diesel from Brazil, that's probably going to sustain somewhat. I think the other geopolitic issue was even yesterday, the news that we saw about Kuwait's airport, that being attacked. That's been bullish in nature on the spreads in terms of immediacy. But I guess the nuance here is there's not that much supply which is leaving the Gulf anyway when it comes to middle distillates. So it doesn't affect things from physical cargo flow perspective. But the sentiment is there. This is the first attack on a major piece of civilian infrastructure in the region for quite some time. So the kind of fear or the risk factor is definitely higher than it was last week as a result. And then the point about Bab el-Mandeb. So yes, obviously this is an escalation potentially if there is real threats to close it with the Houthis or whatnot. But as Neil mentioned before, the arbs from India are close to Europe. There hasn't been that much flow or any flow coming through the Suez anyway. The other major source of Middle East diesel from Yanbu, that wouldn't be affected by this. So I think you could argue that maybe the bullish note that we've seen on gas oil, on spreads, has maybe been a bit too aggressive in the last few days. And actually, in terms of my idea, I think maybe the more interesting thing is potentially looking at some deferred cracks, especially for Northwest Europe. I mean, the seasonality impact is there. And that's when really, if there is anything on Bab el-Mandeb closures or disruption, then it becomes more relevant because that's typically when Europe needs to lean more heavily on east of Suez supply. So that's one thing to consider. And reflecting that, I think it's still quite early, but I was looking at the forward curve of ice gas oil, and I do see, at least versus last week, we do see the back moving up a little bit higher relative to the front. So maybe some people have already considered that as well. On the more routine basis, I guess the ARB status for Europe, West Coast India, as Neil mentioned, it's pretty much closed everywhere except Singapore. Houston, of course, naturally pointed towards LATAM and WAF as well, and the Far East, that's pretty much shut as well. So the supply situation for Europe, though it's not a major problem now, maybe in line with other markets, it will be a problem in 1 or 2 months if ARB stay in this way. That's kind of why I thought about the European markets. I know Neil had some interesting thoughts on Hogo given what's happening.
No, maybe I would just sort of is it worth being long in Hogo still? The one sort of piece of nuance that I think I mentioned earlier was the total US diesel inventory situation isn't as urgent as it was. So if you look at their stocks, they actually built for the last 3-4 weeks, partly on higher runs. So it looks like there's a bit of a solution emerging. One of the things that's happening, I noticed in the data, it's the worst data in the world, but the demand numbers from the US, the weekly ones, have absolutely plummeted. So it looks like there's perhaps a sign of demand destruction. But the one problem is, Pad 3 has been building on Pad 3 diesel, but Pad 1 has been drawing. And pad 1 now actually looks pretty low, like critically low. So like I've been saying the last couple of weeks, I think there's still the chance that within a couple of weeks, you might get some problem on the NYMEX pricing center, right? We've seen that before. And it's maybe too early in the cycle because expiry is still a couple of weeks away for NYMEX. But if we get another draw or two, and then we approach expiry, it might get quite interesting already this month. And I think in this situation, yes, total US diesel stocks are very important for cracks and heating oil spreads, generally speaking. But if you have pad 1 that has a very specific problem, then we should be very aware of this in the back of our mind, particularly in the next couple of weeks. So I think that's the thing on the Hogo. It depends a bit. Let's just watch the data, but there's still a chance that it's worth being long.
Thank you very much. So let's move on now to crude. Neil, we spoke a little bit about China, but tell us the global story right now around crude inventories and our potentials.
Yeah, the thing is that increasingly I don't necessarily know what to say on crude. It's a very funny thing to say on a podcast when you're just about to start a crude section. Dubai is very difficult right now. Like thinking about sort of the Brent Dubai EFS. I don't want to touch like time spreads, don't really want to touch flat price. I have an idea of where I think these should go medium term, but still the most obvious one to me is the TI Brent kind of trade. Not that it has no tail risks. It's got loads of tail risks, depending on what Trump says, in the next few weeks. But I still think that's the most obvious one. The problem right now on that, it's already narrowed a lot, so I think we started May at like minus $10 per barrel. That's moved into minus 4 or 5. At least half of which is kind of freight related, but not all of it is freight related. But so it's already made a big move, and I think that's kind of justified. If I look right now in the tool, the TI Afra ARB looks a lot worse than it did. That's what I was basically calling for. It just hasn't really been the way I thought it. It hasn't happened for all the reasons I thought it would. Part of the reason is that the North Sea diffs have really cooled a lot, several dollars per barrel in the last week or so. And so if the Afra ARB's already basically closed and you have the situation on freight where TD25 looks like it's going to rally because the Afra list has plummeted in the US Gulf, I get a bit worried in the very short term. So I don't feel like being any longer TI Brent right now. I think we need to figure out what's going to happen on freight for the next week. But generally speaking, I think it's done the right thing at TI Brent paper. And the thing is also, if you look at the US stocks, like I said, the draws are accelerating. We drew something like on commercial about 250,000 barrels per day. I think it was in April, I was looking. And in May, we accelerated that to more like 750,000. And last week it was 1 million on commercial. So the thing is getting worse. If you look at Cushing levels are now 22 million barrels. 20 is the minimum. Right, that's the point at which you get a big problem. So we're very close to that. And we're getting into the season where Cushing should draw because you got pad 2 runs accelerating. You started to get news about wildfires. Those are always very interesting for TI Brent spreads for Cushing. And it's only the start of the season. So it's very, very difficult for me to tell. I think at some stage, the TI Brent paper will ignore the sort of freight picture. Let's say freight does rally a bit. I think TI Brent will start to ignore that because it's trying to say to the world, I'm fine with freight rising because I want this Afra ARB to Europe to be closed because there's not enough crude in the US. So come back to me next week. I'm not feeling super. Yeah.
Can I ask a question about this 20 million? That's the bottom. How do we define that? Because again, we don't want to make the mistake of crying wolf where, okay, 20 million, you reach that and then like you see it's a binary kind of situation again. It's like, okay, you reach that level and then it's the end of the world. No, well, not that you're saying that, but how do I interpret this if I'm not a crude expert?
Well, it's historically the level. Once you start to approach that level, you get things changing, right? You get the TI Brent shifting. You get MEH, the spread between basically the Gulf Coast and Cushing, starts to change to try and cut off the flow of crude from Cushing to the Gulf Coast. And historically, over the last few years, once you start to approach 20 million barrels in Cushing, that's the point at which the pricing tends to shift a lot. And that's kind of like reasonably widely known as, this is the level you need to look at. Below that, you start running into operational issues. There's minimum stock levels that you need just to operate. So yeah, it's not exactly 20, but if you got to 19 or 18, the spreads would have changed massively. Let's just put it like that.
Yeah. Okay. Thanks.
Yeah. And I just wanted to pick up also, so just to be clear, I'm not making a TI Brent recommendation this week, but check back next week when I might feel like it's time to be long again. And there's one other problem, which is the physical diff situation in Europe. So I think you remember about a month ago, I was kind of long the physical diffs, and that did work out. And then we've got our little spreadsheets. Then I was like, okay, that's enough. And the diffs have started to cool. And I guess I didn't really expect that. What I think is happening is you just have a lot more crude in Europe than you expected, which makes logical sense with the price. A big problem, I think, is you had quite a substantial flow of US SPR crude heading to Europe last month. So that's one thing that wasn't expected. You have a problem in WAF. It's clearing okay, but I think it's more going to Europe than to Asia. And a big chunk of that is likely to be Chinese buying. So obviously China takes a lot of Angolan, and those are one of the first ones to weaken last month. So it makes sense that low Chinese buying is influencing WAF. And you have a lot more Kazakhstan production than I think people expected. So there was Tengiz maintenance, there was problems at Tengiz, and that's all basically been sorted. And you can see the CPC diffs have also weakened a lot over the last couple of weeks. So there's enough CPC. And in general, it looks like you had decently high US total crude flows to Europe in May. I've been looking at those charts, which made sense with what was back then a relatively open TI ARB. So that is all trumping the lack of AG crude going to Europe at the moment. Yeah. And what's happening, like I say, if you look at the 40s diff, it's come right off $2 per barrel already, and it's putting pressure on the TI ARB. So kind of interesting. There's enough crude in Europe. There's not enough crude in the US. If I just would say that statement, it's a reason to be long TI Brent again. But
so the only thing holding you back on the TI Brent is price. Is that is it already priced in, or does it have legs?
It's already quite narrow. Let's say it's done enough on the ARB. Plus, freight looks quite tight. So the Afra list in the Gulf Coast is much smaller than it was. And normally, if you're going to get a freight rally, you're going to get the TI Brent to widen out to kind of adjust for that. So that's what makes me worried right now.
So it's maybe one of those things to keep an eye on as, buy the dip kind of scenario. Be price sensitive, but the fundamental story is still there.
Yeah, not just going to say be long TI Brent for the next 3 months, right? There's going to be times where you have to be very careful.
Very clear. Well, on gasoline, obviously we've seen the drop in sympathy with all the other products on spreads, cracks, etc. We're now starting to see a little bit of a bottom, a potential rebound. Obviously, the speed at which the market came off is also linked to the fact that, let's face it, a lot of people were just long. The vast majority of the market was long, and given the extreme circumstances, you cannot blame them. But we got to the point where, if you think about spreads, $40 or $25, it does the same job, So can you justify 20 or 40? Well, at the end of the day, you're emptying tanks anyway, So you're entering in this murky kind of environment where what is the right price? And that is difficult to assess, particularly when you don't have very clear news coming from Hormuz or the conflict, etc. But last week we saw, why are we seeing this sort of momentum building, particularly around Europe, different scenarios, So in Europe, we saw that the RBOB opened up again last week, but closed back now, mainly because we saw a little bit of stocks in Pad 1 came up a little bit. I think that surprised a bit the market. But at the same time, I think freight has had a big impact, and TC2 has come off quite significantly. And you're now starting to see that ARA is the cheapest source of supply into many LATAM countries, and particularly Mexico. And obviously Mexico has a similar kind of spec as E5 or EBOB. And so there's a potential kind of trade opportunity. So that's something to monitor. That's the first kind of potentially we're hitting a bottom. As I said before, when it comes to cracks or spreads in Europe, we're at the mean of the last 5-6 years. So again, if let's say that it opens tomorrow, you still have been drawing stocks globally on whether it's gasoline, crude, etc. So is it justified to be at the mean of the last 5 years, even if it opens tomorrow? I don't know. It does seem cheap. Let's just put it that way. I don't know if you disagree, but that's one thing I would say. Yeah.
Like that across the board, like everything seems too cheap. Like really, I mean, with maybe the exception of ICE gas oil spreads, they came up a lot, but a lot of things look too cheap, to be honest.
Yeah, I mean, and maybe we're underestimating demand destruction, and demand destruction again is not necessarily binary. It's not like I buy or I don't buy, but maybe I buy less. I fill up my tank instead of full, $20 at a time, or waiting for the market to come off, or I don't know. I mean, but maybe we're underestimating that, and so but just on, the evidence that I'm seeing right now, I think that we are touching that bottom on spreads and cracks in gasoline. And as I said, just to continue with the picture on Europe, the East-West obviously has rallied, and I'll talk about that in a second. But what it means is that now Europe has other alternatives outside of just the Atlantic basin. So we're now cheapest source of supply into places like Australia, Kenya, Tanzania. So it's not going to necessarily affect the pricing center. You're not opening ARBs into Singapore, but obviously that is a signal, and it's a signal for freight. It's a signal for gasoline in Europe. So that's something to keep an eye on. At the same time, as I said, E5 blend margins are still positive. And that's one of the things that when we were talking about the market 3 weeks ago or a month ago, they were widely open. And it was a very strong signal that the spreads were way too high. So that's something to keep an eye on, because if you're still, it's also a function that maybe the ARBs are open and maybe we're just calling it too early, but people are not necessarily locking in those ARBs yet. And therefore component prices are perhaps too cheap. And therefore E5 blending is an opportunity. So people might start offering in the window. It's possible. So keep an eye on those E5 blends or E10 blends, but they're not as open as they were a month ago, where it was like a slam dunk, $10, $15 a ton. Now it's more like $2, $3. So it's not that exciting. And it's not the canary in the coal mine kind of situation. But so I would be constructive on this situation. Now, in Singapore, what we've seen is that I think that the main story is what you were saying about China. At the end of the day, if China ramps up exports, then it puts a cap or a lid on any kind of spreads. And as a consequence on East-West, although East-West is not really the number one trade here, it's more around spreads here. But obviously, we've seen that rally on the East-West that is now allowing for these ARB opportunities from Europe into East Africa and even Australia. But the most important thing to look at is Chinese exports. And if they, as you said, they're not happening or not as much as people expected, then you could see a continued rally on Singapore spreads from where we are right now. And let's not forget that they did come off quite a lot over the last 3 weeks. So what I'm trying to say here is that on a pricing perspective, we've now got to the point where, and if you use the mean of the last 5 years as your indication of what is cheap or not cheap, relative to the circumstances right now, I think that this is a good moment to start getting in. And also on a paper market perspective, a lot of people got out of their positions. When you have a sell-off like that, it's just, risk management, and you were long and you needed to get out and you're taking a loss and all that. And maybe, so then you have the moment where you need to lick your wounds, and maybe you spend 2-3 weeks waiting. And we're now starting to see the evidence of a potential risk on scenario, I would say. And just on US, as I said, Europe is now taking a lot of that, winning the battle in the Latin market, etc. So can we see an impact on CBOB versus RBOB? Maybe it's, maybe, but I don't have a full picture on that, I have to admit. Any other comments on gasoline? Do you guys have a different view? Or
I think not on gasoline, but what you said on demand was quite interesting. It reminded me a little bit about COVID time. So I think one of the hard things to get really good data on is the extent of demand destruction. And maybe that's what we are missing in terms of why the solvers don't seem like they're solving perfectly. And yeah, maybe it could be the case that demand destruction is actually higher than we think. We'll only really know probably well after the fact, unfortunately, given how the oil markets work, for sure. But I think it's just always something to keep in our minds, because demand is very, very hard to ascertain. But also I think there is a big difference in the way the demand profile looks like for us in the Middle East and Europe versus, let's say, East Africa and Asia, given what's happened so far. And given the absence of data, it could be the case that that's the core issue.
And you know what, jet is the best example of that. At least European perspective, and I assume in other countries, in other places as well, everyone was so dramatically emphasizing the fact that we would not have jet fuel in this summer or early summer. What we saw is a lot of, first of all, flight cancellations from the airlines, but also a lot of people that decided not to fly because they were afraid of not being able to come back, or they would just, there's this sort of psychological barrier that, it's so expensive. And, and a lot of flights people did not fly that much. And we saw that demand destruction, if you want, at a time where we needed it, but it was not really fully anticipated, I would say.
Agreed.
If they're not going to fly, then maybe they're going to drive. Just to put that point out there.
Are you aware? Everyone is like, okay, well, there's actually not, there's not a big issue anymore. You know, when you talk to non-oil traders, it's like, oh, come on, you know, you made a lot of noise, and actually nothing has changed. You see, so maybe we go back to the sleepwalking, and we might end up in a scenario where demand actually surprises us instead of on the upside rather than the downside.
Yeah.
But again, pure speculation. I have absolutely no data to support any of this, but it's just.
I've got one piece of data. So I was going to talk about it at the start of the pod, but there's now Brazil data for April. And what happened in Brazil in April was, firstly, they hit a new, I think it's a record high for their domestic refining runs. So they maxed out crude runs as much as possible. That partly resulted in their crude exports declining. Their diesel demand dropped quite a lot, I have to say. So it's been growing at a fairly steady year-on-year growth rate, and that was visible up until March. And then in April, it's dropped down basically to last year's levels. Yeah, maybe it makes sense. And the net result is that the Brazilian diesel imports in April were actually quite low. So it is a piece of data. You know, maybe that's been replicated in various other places. And just a note, we will get Jody data for Europe. I think it's next week. If it's not by the next pod, it'll be in the following pod. And that will be for April. So we'll get some April data so we can talk about that.
No, and anecdotally, you know, when you listen to, you know, senior leadership at trading companies, etc., you know, a month ago, the sort of finger in the air kind of demand destruction number was roughly 4 million barrels a day. Now people are talking about 5-6 million barrels a day of demand destruction. And again, and the prices are not necessarily much higher than they were a month ago on a fat price perspective for finished products. Actually, they're much cheaper.
Yeah, but that also begs the question, just whilst we're on this, like, how much has been natural, like price driven, and how much has been kind of, because, you know, we had this whole thing in Asia, there was kind of government measures to kind of preempt the shortages. So there's been an element of demand that has been forced lower by measures, let's say, and it isn't necessarily price. And at some stage, if the price is lower and governments get a bit more comfortable, you know, maybe that demand creeps back. On the other hand, a big chunk of this demand number comes from China, right? So we're seeing reports about Chinese domestic demand might have declined by 10%. And you just think of that number and you go, what? That seems insane. When did the price get so high on a sustained basis that would justify 10%? And I suspect it's a dodgy number because, I mean, Chinese demand is difficult at the best of times. Yeah. But, you know, the assumptions are quite wild. I think we're only going to get a clear picture globally in 2-3 months' time.
Well, and then we'll ask again, what's the new situation, you know. But anyway, guys, this has been fun. Thank you very much. And I'll see you next week. Thank you very much.
Thank you.
Cheers. Take care.
Bye.